It's time.
We got the alt queen back, of course. She's here, queen of alts, and I cannot tell you guys enough about how much just I love Shana in general as a person, but also what she's doing for our markets. And I think this conversation today is timely. We're in a government shutdown. Gold's at all-time highs, markets all-time highs. Bitcoin was all-time highs. Now it's doing its own thing. What better time, in my opinion, to talk about alts and figure those things out? So without further ado, Shana, welcome back to the show and welcome to the collective.
Always good to be here.
So during these times of events, everyone always is looking for yield. They're always looking for safety. They're always looking for something else than what's going on. And it's tough. It's not the easiest thing to do when we're at all-time highs across almost every asset class that you can think of. But that's where I think thinking differently, being alternative and bringing those out comes into play, because the majority of people, we've talked about this ad nauseum on every episode, and why you have your business is because people don't have access. They don't know what's out there. And that's vitally important. So with that being said, let's first answer the question of why are alts coming more into the spotlight during these types of times?
Well, I don't know if it is causation, is correlation kind of thing. I do think part of the reason why we're having a lot of alts conversations is because they're more accessible than ever. And that's a fairly new phenomenon. And so it's just a topic of conversation every day, as more and more things that were once unavailable to the average investor are now available to the average investor. And that trend really started a couple of years ago. Like, I could give you the history lesson, but I would say the first opportunity for alternative type strategies to be available to the masses started with regulatory changes in 2007 that allowed mutual funds to start to have BDCs and private REITs, which have always kind of been around, but then platforms like iCapital and Case came to market that allowed for those types of products to be found and more accessible through, just being able to be platformed. And also, I think people were more willing to take a look at some of those structures. You had SPACs come in, which kind of disrupted the IPO market in some ways, again, making, some of that stuff more accessible. 2019, 2020 is when active ETFs really got all the necessary approvals to take off. So then you start to see alternative active ETFs, because going long short and stuff was really difficult before then. And then in the last, I would say 3 years, really the last 18 months, you've seen the rise of interval funds and the desire to bring certain specific asset classes to this market in an accessible way, private credit being the biggest and most obvious one. But also we had changes at the NFL level that put sports rights in the crosshairs, and you had the Caitlin Clark effect with the WNBA, which suddenly made people realize, hey, maybe that's a good investment. So then sports rights funds. So some of it is that people see a broader availability. There's so much stuff that wasn't even available like 5 years ago that's available today. Discussions of like private product in a 401k plans. It's just in the headlines. It's all the networks are committing significant airtime to it. More and more products are coming out. So it's just everybody's paying attention. All of that said, we also have a market that, stocks and bonds are behaving in concert with each other in a way that they typically hadn't. So that really puts under the microscope this idea of, is 60-40 going to do okay if there's any kind of stress in capital markets in general? And I say capital markets because I want that to encompass like any kind of investment instrument that's publicly traded. That includes fixed income. We have volatility in fixed income markets because of the Fed and inflation and tariffs and you name it. And so people are more and more looking to these private markets that now they can access for potential ways to add diversification into their portfolio, add income to their portfolio. And on the advisor level, it's really a place where you can customize and find more nuanced and niche opportunities to align with your clients to help you stand out from the rest. Because let's be honest, everybody can access Blackstone, Carlyle, Millennium. Every advisor on earth can send an email to Case or ICAP and get a login to access anything on those platforms. So that's no longer something that is a differentiator. If everybody can do it, then, how does that make you different? Model marketplaces, TAMPs, wrap programs have kind of streamlined and resulted in these models that everybody accesses, because Fidelity's model that's on Orion's the same one that's on Envestnet. It's the same one that's on the UBS wrap platform. So how do you differentiate yourself from the peers? It really does come down to some of this stuff in the alt space, because at the end of the day, it's really the only area individuals need a financial advisor to access. Yes, I've mentioned access is easier today, but it still doesn't change the fact that it's super complicated. And a lot of the access point is at the financial advisor level, not the retail investor level. So, as an advisor, if you want to bring in new business, this is your path to do so.
Couldn't agree more. Could not agree more. Our next segment is what society and media are saying. This is a fun one. I like to dispel some myths in everything that's going on. So first one is high yield solves all the problems.
Can that be a gray area? So high yield can help in a society that's increasingly focused on income, right? Higher yielding instruments can be a solution. In the institutional world, especially in pension, we talk about something called liability-driven investing. The whole concept of LDI is that you only have as much risk in your portfolio as you need to get the balance to a point where you can just go to yield instruments to generate the necessary cash flow you need to meet your obligations. If we take it down to like the individual level, it's no different than I need to be able to meet my household expenses, and I will only take as much risk as I need to be able to get my portfolio to the place where like I can literally just get a monthly check of income from my portfolio to meet those needs and move on. The less you have to put at risk, the better. So taking an LDI approach makes sense. That's what target date funds do and all that stuff. That's the goal. So high yield, obviously, and yield instruments can provide you cash flow and stable cash flow to meet whatever your goals are, if your goals are related to income generation, retirement, things of that nature. However, understanding the risks associated, because everything's a risk return, right? There's always a trade-off. So to get more yield, there's a trade-off. It could be risk, but it also could just be liquidity. And there's right now in the alt space, that's where we land. So there's a number of awesome income generating products that generate substantially more stable and higher income rates than traditional fixed income and bonds and mutual funds with bonds in them and things of that nature. The distributions are monthly and steady and very consistent, but the trade-off is liquidity, right? The trade-off is liquidity. It is being generated from assets that are usually private credit or some sort of floating rate vehicle. And the risk depends on where you are in the space. So I like to say the vast majority of the products that get all the headlines that people have the most interest in are like the high flying ones that come from the big sponsors like Apollo and Blackstone and the big guys. But those funds raise billions of dollars of assets, and they're not going to be able to put billions of dollars of assets at work like $1 million fund. $1 million loan by $1 million loan. So they're only playing in a pond where the potential issuance, the lending opportunities are in the hundreds of millions of billions of dollars. And that's not the majority of businesses. Most businesses in the US, I think it's something like 75 or 80% of businesses are small businesses. So the kind of lending they need is in the $1 to $2 million range. And there's plenty of opportunity there, but that's not what is vastly out there that people are paying attention to. Those lenders, the lower middle market, are increasingly more important and can be far more judicious in decision making of what they want to do. We have one on our platform, Meriwether Group Capital, and they do $1 to $2 million loans to small businesses that are asset heavy and specifically in the Pacific Northwest, so very narrow. But Jamie tells us all the time, he sees anywhere between 75 and 100 deals a month, and he does maybe one. And when that's your pool of opportunity and that's the kind of demand you have a lot more ability to dictate the terms of those loans and the stability and the risk profiles. And no one's going to fight you on the higher than average interest rate because you are their only option. And so, but you give up liquidity. And so that's a trade-off.
Next one kind of pulls into a little bit about the risk overall. Investing in alt, it says investing in alt is inherently more risky than anything else that we invest in with our 401ks, stocks, bonds, mutual funds.
False. Inherently more complex, but not necessarily risky. And if you look at alts as a collective that includes private equity and private credit, perhaps, because private equity and private credit have the same risk profiles of their public market counterparts. Private equity is inherently as risky as public equity. Just is. It can mask it because it doesn't have to mark to market. And so it can look, it's called the smoothing effect. That is the polite and respectful, educated way to say it. Cliff Asness likes to call it volatility laundering, but it's the same concept. You don't have to price it every day, so you don't have to. If you have to price things every single day, you're going to inherently have more volatility than if you get to pick the point in which it smooths everything out, because you don't have to experience, at least on paper, the ups and downs that occur in the markets. But then they're called hedge funds for a reason. The hedge in hedge is just that. Things that are in that space are inherently trying to mitigate risk somehow through a hedge. How they achieve that varies. And some ways are riskier than others. Anytime you start bringing more and more leverage, and it's synthetic leverage. So a perfect example of that is anybody who's ever read any book that has to do like Liar's Poker or something that has to do with long-term capital management. Long-term capital management inherently was investing in a very low risk investment. They were investing in treasuries and sovereign debt, but they were doing it with like 50 times leverage. So they were magnifying their exposure, which when you're dealing with something that at best can give you 50 basis points of monthly return, you need to do that to get meaningful return. But that also means that you magnify a small 50 basis point drop 50 times too. And so leverage inherently magnifies your exposures. And so even for every dollar of leverage you have, you might have, if it's 2-time leverage, $2 of exposure, $3 of exposure. In Europe, you can get ETFs that are 20 times levered. Here, I think it's limited to 3. But that's just a reminder. In fact, I did an interview yesterday where somebody was like, how is it there's only $100 million in equity leveraged ETFs? And I was like, yeah, but if they're all 3 times, the actual magnified impact on the market is that it's $300 million. And so, but there's other kind of leverage too, like leverage through debt. So there's alts that use this concept of return stacking, right? That's actually not using synthetic leverage. That's using the kind of leverage you and I use every day when we buy our house or buy our car. We're simply borrowing some money at a rate that is lower than we expect our return to be. I mean, not necessarily with a car, but with a house maybe. And return stacking is that idea. And that's actually what a levered buyout is as well. Like you borrow money to do the buyout. How much? Your loan to value matters. Same thing with a house. But at the end of the day, if your expected return on a portfolio is 10% and the cost to borrow to make that investment is 2% or 3%, or let's just say 4% if we want to look at current rates, right? You have a 6% spread, so you can pay off the debt and still make 6% on top of it. And that's the concept of return stacking. That kind of leverage is inherently less risky. And so what kind of leverage matters? So alts can actually be less risky, but more complex, or far more risky. It depends on the use of leverage. And sometimes there's no leverage being used at all. You're just playing in a market that's inherently less liquid.
Agreed. Next segment is your point of view, and I'm going to roll right into what we had just ended with there, and that is, one, you work with a lot of advisors. Obviously, I'm an advisor. I have a lot of advisors. Inherently, though, the media, the market, if you will, and the general public is going to listen to what you just said, glaze over their face and their eyes and go, what the hell did she just say? I don't want to deal with it. It's too risky, right? Because that's how their brain works. Complexity equals risk, and it's not the truth. How much of, obviously, what you do every day, but how much is it the lack of understanding the complexity in an advisor, since it's going to be driven by us, not willing to learn something maybe different or somewhat new to them to provide this to end users?
It's a lot. So I would like to challenge the advisors listening to this podcast and say your superpower is your ability to learn these things so that your client doesn't have to be scared of them. I remember when I was sick and in the hospital, my brother-in-law said this to me, and it was so right. Fear is basically lack of information, right? The more informed you are, the less fear you feel. And so as an advisor, I think your superpower and your opportunity here is to be intellectually curious and be like, look, I may not understand this, and I'm scared of it because I don't understand it. And I might have reason, right? But the only way I can address whether or not my fears are warranted is to educate myself. These are more complex things, but that's what they pay you for, right? Like if they could do it themselves, they would. And if there's stuff that's not complicated that they can do themselves in this world today as it stands, where I would argue the general public is more financially literate than it's ever been in the past, right? You need to be able to provide some sort of knowledge or understanding beyond what they would be capable of doing on their own. And with every app that's out there that's seeking to like do this, and all the influencers and like my friends over at Wall Street Skinny do great work. There's so many out there, that Mrs. Dow Jones, there's so many good influencers out there that make finance and financial concepts accessible to the average person, where you can learn and understand, and people are just more interested. I think that came out of COVID, because when there was no sports, like everybody went to the market because it has a similar like gambling like look and feel, and same idea of like just being educated and figuring out probabilities. But my point here is, as an advisor, I challenge you to take on that task, and also to go in with the understanding that there are people who want you to be uninformed. There are a lot of people in our business that benefit from you being uninformed. And so anytime, and I'm not going to mention the firm, but I recently heard this from an OCIO firm that reached out to us about helping them do alts, because that's not what they do. They said that they had recently lost 3 clients to a TAMP because a very large asset manager had put on their model marketplace models of interval funds, high fee interval funds. But the trade-off was, if you invest in our model, we will pay the platform fee for you to be on the TAMP, which is fine. But when things are like that, you have to ask yourself, what's the incentive for them to do that, right? And a lot of times, if something's being given to you for free, or if somebody's offering to pay a fee on your behalf to get you into it, there's an incentive there to do that. And usually it's because they don't want you to be educated to see through that. And so go in with that level of like skepticism, and understand that the industry as a whole, and a lot of the custodians, don't think you're very smart. Correct. So they feel like they need to protect you from yourself. Those of you who work for big aggregators, your home offices make you take all those exams. because not necessarily because they think you're an idiot, but because they really don't want the one idiot to cause the SEC to fine them like billions of dollars, right? And so they're going to make you jump through hoops. It's not intended to just make it harder. In fact, I would argue that if you're willing to jump through those hoops, you put yourself in a position to be a smaller percentage of advisors that was willing to take the time to go through that process. It's like anything. Like, I'm willing to take the CFP test. That means the sacrifice for that is got to sit down and study and take the exam, right? Yeah, same thing. If I make it a little bit harder for you, it could be the things like, yeah, I just don't want to deal with it. Or it could be the 90% of people are going to come against that roadblock and be like, I don't want to do it. But you are not one of those 90%. And that's why you're going to be able to get through it and reap the rewards on the other side. And so anytime you hit a roadblock, I always like to tell interval fund companies I work with, because they're all like, well, it's a ticker. And an advisor can just, I was like, no, I need you to go and talk to Fidelity and ask them, if an advisor wants to buy my product, is it as easy as just putting in a ticker? And they might go, well, yeah, of course, after they fill out XYZ forms, after they change their client risk tolerance. And if the advisor knows that coming in, if I, as the interval fund sponsor, says, hey, it is as easy as just putting the ticker in, you might need to do the first time XYZ and prepare them for that, they're much more likely to go through with that process than if they don't know, come up against it, and are like, dude, you said it was easy, and then they told me I needed to fill out this form. Forget it. And you've already started that relationship off the wrong way. So as an advisor, I just encourage you, be intellectually curious. The resources are out there for you. Banrion has tons of them. Go to our YouTube page. We have video after video of our podcasts. We talk about this stuff all day long. We have resources internally for our advisors for this express purpose. Get on our mailing list. We send out, like, I'm going to be sending out something the other day. Michael Kitches put out a great thing about the importance of diligence and like what the regulators require you to have. I'm going to talk a little bit about like how you can find resources either with us or with others that can help solve that stuff and make it less intimidating. But at the end of the day, just be willing to be open-minded, because that's what you need to do if you want to continue to grow your business. I realize there are some folks out there that's not their priority. They have a nice little business. They're retiring in 10 years. All they're really worried about is like to make it that far and then hand it off to somebody else. But for everybody else, we are now going into a world where we're going to change slowly but surely from an AUM-based revenue model to a fee-based for service or coaching model. If you are going to justify that type of thing, you got to do something that's worth paying for. And these are the things that will allow you to do that.
Really what you're saying is, advisors, do your damn due diligence, have an open mind, and learn something. At the end of the day, right? And the due diligence part's massive. And I know we've talked about it, and you guys do due diligence all the time and have to. When you're evaluating a new offering or a new manager, can you simply give us a little background of what you look for when you guys do your due diligence?
Well, I'm going to start by saying there's a lot of people like Banrion that do due diligence and provide it to advisors, and advisors can come and work with us and have access to it. The number one question you need to ask anyone who is a provider of due diligence is, what is their revenue model or their incentive basis? If that provider is in any way receiving any compensation for fundraising, they have compromised due diligence. And you need to remember that, because the regulators consider it compromised. Not everybody has compliance departments that catch that, but many do. And therefore, you're going to have to do your own work. And if you don't have the resources, that's a problem. Then there are others, Banrion's one of them, but there are other firms where they are not in any way compensated or get kickbacks for fundraising. Those are considered not in conflict, and you can actually rely on those. What you want to focus on, and in any investment, we know suitability, portfolio construction, risk mitigation, or understanding the risk associated, what could go wrong. I always like to start with, I want to understand what could go wrong a lot more than what could go right, even if it's a low probability risk, because I just need to know. Even if it's unlikely to happen, I just want to know, because I want to know how bad that could be, so I can be prepared. So I always focus on that, because the issuer is going to tell you everything that could go right. I want to know what's going to go wrong, even if it's a very small probability. The second thing you want to focus on, and it's particularly true in alts, particularly if you're dealing with an unregistered product. So that is not an interval fund, not a mutual fund. If it's not registered with the SEC, then additional due diligence has to be done on structure. And that means you want to make sure that whoever is the issuer or the sponsor of the product is using high quality third party vendors. So you want to know who their outside legal counsel is, who their third party administrator is. If they do their own in-house administration, you want to know at least that they have a third party person that's doing their underlying valuation metrics and what that looks like. Like, how do they value non-liquid securities? Like, who does it? What's the methodology? You want to understand that. And you just want to make sure that those things are. Also, background checks of the individuals. Quick Google search has oftentimes found that somebody had like a major fine on their U4, or an article that they're in, or just like a general background check that you can spend $30 doing is helpful in those cases as well. And you want to, check references, things of that nature. But those are the main ones. You want to understand like how they do their performance reporting, what systems they use to do that, how they calculate the performance. That you want to understand how they do their accounting, all that stuff. That's the most important part actually in alts, especially private alts versus, the registered stuff. But that's not to say bad things can't happen in registered product. It certainly does. But at least you have the cover of the SEC a little bit. Because if the SEC missed it, then it is what it is. There's plenty of stuff that the SEC misses that I've seen and I've just passed on. But there's definitely been plenty of funds out there that blow up. I always encourage people to look at the prospectus, everything on the website, all of the fact sheets, that's marketing. The details are in the prospectus. You want to look at specifics of how they get exposures, if they use derivatives, how, if they're making some sort of buffer funds. I love this. They're making sort of guaranteed outcome kind of thing, defined outcome. How defined and how guaranteed is that? And how are they achieving it? A lot of them have in their perspectives yeah, this isn't guaranteed at all. We're just hope and pray. And we think we do it in a way that will come to this outcome. Yeah, you want to know that. Fees in the alts world, same thing. The SEC has some weird ways that they require anybody who does shorting or uses derivatives to calculate their fees. And some of it is phantom. Shorting is a good example of that. When you short a stock, you have two things that are cost. One, the cost of shorting. So there's margin interest, right? You have to maintain a certain amount in your margin account. And if the value goes up or down, it adjusts. And then you're borrowing shares. So there's an interest rate associated with it. So you pay that. And then the other thing is if you're short a stock, then there's a dividend payment owed to the person you borrowed the stock from that you have to pay. The SEC requires those two things be calculated into the expense ratio for the fund, but it's not real because those exact same things are actually calculated in the value of the actual position. So it's already taken out in the position value. The SEC just makes them put it in the expense ratio for math. It's not actually the cost. And so a lot of times if you go to the prospectus of these funds and their breakdown of their expenses, they actually show you those things. And then you can clearly see what the actual expenses of the funds are.
And everyone listening, both advisors and investors, clients to be, it's a lot of work, right? A lot of work. That's why Bernard does. That's why you do what you do. That's
why I exist. That's why people hire me.
Because it's a heavy, heavy lift. Mm-hmm. There's a massive value there, both advisors and clients, by the way. Huge, huge value there. And I think you've you've nailed it, one, because of what you guys do, but also I think the advisors need to take a little more ownership of that's also part of the value you bring to the clients.
Mm-hmm.
That is part of why AUM is dying and we're getting into more fee-based, because clients want to pay you to do due diligent things, like figure all those things out for them, simplify it. How does it fit their plan or does it not fit their plan?
Mm-hmm.
And ultimately, that's what we're looking for.
Exactly.
Which gets us to this question, the final one of this segment, and that is, who are alts for and who are they not for, in your opinion?
So I would say alts are for everyone.
Woo!
Specific alts might not be for everybody, but I could argue that there's something in the alts universe for everybody. People with substantial risk tolerance, Bitcoin, high flying levered venture capital, that kind of stuff, mezzanine debt, distressed debt. And then there's stuff that's just, very low risk, income producing kind of stuff that is for others. There's very liquid things and there's very illiquid things. So I would argue this is a massive universe, and there's so much stuff that falls into alts that, like, Bitcoin and gold are both alts on different ends of the spectrum. Different people invest in those two things. They're both in the alts bucket. Real assets, everything and anything you could possibly think of. There's no such thing as a no risk asset, not even cash. But there's things that fall different places on the risk spectrum, in different areas of the liquidity spectrum, and it's all there's a cost to everything, right? Taking on more risk is the cost is the risk. Less liquid stuff, the cost is the illiquidity. You should be getting paid for that, so your expected return should be better than the alternative that doesn't have that. And there's trade-offs. There's trade-offs in literally everything you do in life, every single day, even if you don't realize it. Like what you eat for breakfast, the route you take to take your child to school every morning, how you walk your dog, what time you walk your dog, what time you get up, literally everything. How you go to sleep, temperature in your house. There is not a single thing you do in your life every day that doesn't have some risk associated with it, however small. Same is true in the alts bucket. So I would say alts are for everyone. In fact, I like to always say one of the things that made me so passionate about alts is because I got involved in them during 2007, leading into the financial crisis and early on in the financial crisis. And while alts got a bad rep because there was a lot of alts that blew up, like the thing that blew up the hedge fund that I was working on was Muni Arb and Lehman. And the prime broker issues that led to a lot of funds just not being able to get the resources they needed from prime, which is Bear or Lehman, that made them go under. Or just everybody running for the door at the same time and them having to do a fire sale and not have the ability to name, the price they wanted and not be able to trade the portfolio advantageously and thoughtfully. But the one thing that stood out to me is at the same time, there was a whole lot of stuff that did really well in the alts universe during the financial crisis, like global macro, managed futures, anything that was short biased, and crushed. And so I remember thinking at the time, like, there's stuff in here I wish my dad could invest with, because I could actually mitigate a bunch of risk in his portfolio if I could do this. And now that isn't true anymore. Now those things are available to my dad. And, I'd argue my 80-year-old dad could benefit from some of the private credit or income producing alternatives that are out there in the interval fund market, because he doesn't really need access to all his assets. He just needs his assets to generate enough income to pay his household expenses, and, maybe have enough liquid that if he wants to do something or needs to do something in an emergency, it's there. But ultimately, I would say alts are for everybody because the universe is so broad and their risk spectrum is so broad, more so than even public equities and fixed income.
See, there you have it. Everyone, alts, get them. Last segment, actionable steps. So we've just said everyone needs get them, right?
Yep.
And we're on record of saying everyone should have between 10 and 50%, depending on your portfolio of alts. So we've already discussed this before, but we've never really hit upon this part. And that is when you're looking at a portfolio, and I know you're not an advisor like I am in our job, but but still you look at portfolios.
Right.
When you look at a portfolio, what's it like a checklist, like maybe a 3-step thing that when someone's going, and as an advisor, I need to add alts or I don't need to add alts. What's kind of a little checklist in your mind that you do when you're viewing a portfolio?
So I love the way you teed me up for this, because I'm going to tell you a little something about how Banrion approaches this, which I think is really unique. And it gets to the heart of what you just asked me. What Banrion does as a resource to advisors is we do the due diligence and we create a research report. Now, typically, if you were to go and get a report on a product from, say, Morningstar or, anybody, they would rate that. There's a rating. And I always hated that, because when I worked at a large OCIO that was also part of a firm that had like investment consulting research, I always used to be like, okay, you're giving that rating on like a vacuum, like with because something may work, like it's the best performing large cap value equity fund out of the entire universe. But what if I'm only doing a portfolio of large cap value, right? There's going to be stuff that maybe on its own solo isn't the best, but if I'm putting it together with other stuff, it actually is a perfect fit for what I'm trying to achieve. And so when we do investment research reports, we understand that only the advisor knows that stuff about their client. Liquidity, tolerance, budgets, tax I don't know any of that stuff. So for me to tell you like this is the best private credit fund out there, taking none of that into consideration, I'm doing you a disservice. So our reports don't include a rating. What they do include is our general suggestions on how we would use this in a normal portfolio without knowing any of that risk stuff. Like maybe position size, we're not really sure, but we know where we would put it and what it would complement. And then we can tell you the things that you also need to have a conversation about. So if it's an interval fund, I might say, you should probably have a conversation about liquidity budgeting to make sure that your client is comfortable with illiquidity and how much of their portfolio they're willing to make illiquid. I might tell you there are some weird tax consequences to the distributions that this fund's paid, and you should probably talk to an accountant so you're not surprised. Because it's going to depend heavily on like all kinds of factors about your client's financial situation as it pertains to how they are seen tax wise and what other things they have that might impact that. I might tell you, for example, we did this with somebody. They were a fund of funds and they were investing in other funds. And there's 2 ways to do that. There's the way where you hire another fund to be a sub-advisor. So I am allowing that manager to manage an account that I own. And then there's I'm just going to put money in a fund that already exists and that anybody can put in. So I'm commingled with everybody else. Those 2 things have consequences. If I own the account, there's a less third-party risk there because I can shut that manager out of the account at any given time, take control. And if I don't do that, then I have there's 100% risk, third-party risk there, right? So counterparty risk. So that's how we do it. And that's how you got to look at these things. I would say the number one things when you're talking to clients about alts is you want to understand what they're trying to achieve. And liquidity, tax consequences, and overall risk profile of a client is the 3 things that you got to start with. The liquidity budget conversation, I feel like needs to just be a normal part of an onboarding process with a client. And I don't believe it is, but it should be. And the same is true with the tax stuff. So you should be working, if you're not their accountant, you should be working closely with their accountant. Because in the alts world, there's like weird things that get distributed that have different tax. The way they're taxed is different than just like qualified dividends or capital gains. So those are the big things. That's where I would start.
I love it. And that's advisors, the ones that are just advisors and haven't dipped their toe into the financial planning side of it. You might want to get started because those questions are what we ask on onboarding. We have that knowledge. We're making decisions based upon that. And if you're missing that, then yeah, you're probably terrified of alts. Yeah, you're probably not going to look into something deeper. And guess what? You're missing opportunities for your clients because you are not, in my opinion, doing your duty of learning these things because it is prevalent to everyone. Everyone should be in alts.
Yeah, I would argue that if somebody's coming to you to be their financial advisor, it's almost certainly not because they want you just to manage your money. Because if they just wanted a money manager, there's plenty of ways to do that. That doesn't involve an advisor. In fact, most advisors are definitely not better money managers than like the money managers that do that 24/7 as a living, right? So at the very least, they're coming to you because they have some sort of goal or some sort of like problem with their budgets or whatever that they're trying to solve for, and they're coming for you to help solve a problem. That problem is not how do I beat the S&P 500. 100% of the time, it is not how do I beat the S&P 500 because they can like buy newsletters to do that. They're coming to you because there's a problem that they need to have solved that they need your help with. So you may not be doing full-on financial plans, but you're certainly helping your clients address a problem or a goal that they have. And you should know what that is, and you should know what they are willing to do to achieve said goal. And what, that will affect suitability.
Absolutely. Well, Shana, again, another amazing episode. Everyone listening, stay tuned in. Coming here the first part of next year, we're going to dive deeper into some of these instruments, some of these alts, and dive deeper into them for you. But we wanted to give you another little taste, right? We've been a little deeper today, but next time we're going to go a lot deeper. Shana, I appreciate you, everything that you do. And everyone, go ahead and check out the bio. It'll be somewhere around here. I don't do that social media stuff, but someone does for me. It'll be there. Go check out the website and make sure you check out BanrionCapital as well. Again, Shana, appreciate you.
Thanks for having me.
The preceding program was sponsored by Black Mammoth. Any awards, rankings, or recognition by unaffiliated third parties or publications are in no way indicative of the advisor's future performance or any individual client's investment success. No award, ranking, or recognition should be construed as a current or past endorsement of Black Mammoth. Information regarding specific awards, rankings, or recognitions is available on the Black Mammoth website, www.blackmammoth.com. All investment strategies have the potential for profit or loss. Investment strategies such as asset allocation, diversification, or rebalancing do not assure or guarantee better performance and cannot eliminate the risk of investment losses. There are no guarantees that a portfolio employing these or any other strategy will outperform a portfolio that does not engage in such strategies. This broadcast should not be construed by any client or prospective client as a solicitation to effect or attempt to effect transactions and securities or the rendering of personalized investment advice due to various factors including changing market conditions. The information discussed in this broadcast may no longer be reflective of current positions or recommendations. While information presented is believed to be factual and up-to-date, Black Mammoth do not guarantee its accuracy, and it should not be regarded as a complete analysis of the subjects discussed. The tax and estate planning information discussed is general in nature and is provided for informational purposes only and should not be construed as legal or tax advice. Listeners should consult an attorney or tax professional regarding their specific legal or tax situation. Past performance is not indicative of future results.